Okay, let's unpack this. Imagine you've found it, that property, with incredible income potential, maybe a multi-unit building, perhaps even a short-term rental, in a hot market that forecasts look amazing for.
Right. The perfect investment.
Exactly. But here's the snag. Your personal financial picture might not fit the classic mold.
Uh-huh.
Maybe you're a highly successful business owner, but your tax returns show a lot of deductions, leaving your reported income looking, well, lower than your actual cash flow.
Yeah, that happens a lot. Smart tax planning, but it messes with traditional loan apps.
Or perhaps you're an experienced investor who has already amassed a portfolio of properties, and you've bumped right up against the conventional lender's limit on how many mortgages you can hold.
The 10 property limit, that's a real barrier for scaling.
Traditional financing, focused intensely on your personal W-2s and debt-to-income ratio, feels like a brick wall blocking your next move.
It really can be very rigid sometimes.
What if, instead of lenders needing to comb through every detail of your personal finances, they could look primarily at the property itself?
Interesting shift.
At its inherent ability to generate income and cover the debt it carries.
Okay.
That possibility is not just a dream. It's the reality of a specific type of financing, and it's exactly the world we're taking a deep dive into today.
Gotcha. So focusing on the asset, not just the borrower's W-2.
Precisely. We are exploring DSCR loans in the U.S. debt service coverage ratio loans.
DSCR loans, right. I've been hearing a lot more about these lately.
They are a fascinating and increasingly relevant corner of real estate finance because they represent really a fundamental shift in how investment properties are financed.
Yeah, it's a different philosophy almost.
They base qualification not on your personal income from a job, but predominantly on the property's cash flow.
Which makes a certain kind of sense for investment properties, doesn't it?
It really does. And it's a critical area for any serious investor to understand right now. For this deep dive, we've pulled together and analyzed a stack of sources that you've shared with us.
Lots of good stuff in there. Lender guides, market analysis.
Exactly, including detailed guides from various lenders active in this space, like New Silver, Griffin Funding, Angel Oak, Trust Financial, Lima One Capital, EPM, NASB, a whole range.
And that AAPL market analysis, right? American Association of Private Lenders.
That's the one. Crucial market data. Our mission here is to take all this information and just distill it down.
Yeah, cut through the noise.
We want to cut through the jargon, highlight the most important nuggets of knowledge, and give you a clear, comprehensive, and actionable understanding of DSCR loans.
What they are, who they're for, how they work.
How the core calculation works, and what the latest market data tells us about this growing sector. It's about getting you well-informed efficiently so you can see if this tool fits into your investment strategy.
Absolutely. This isn't just about definitions. It's about understanding a powerful tool that is really changing the landscape for investors.
Okay.
So let's start right at the beginning.
Yeah.
What exactly are DSCR loans at their core?
Lay it out for us.
Okay. At its core, a DSCR loan is a non-recourse or limited recourse commercial mortgage, specifically designed for real estate investors financing income-producing properties.
Okay, income producing is key.
Absolutely. The standout feature, the defining characteristic, is that the lender qualifies the loan primarily based on the investment property's cash flow generation relative to the loan's debt service obligations.
So, does the property make enough money to pay its own mortgage?
That's the essence of it. It's about the property's performance, its ability to stand on its own financially, rather than the borrower's personal W-2 income, salary, or traditional debt-to-income ratio.
And that difference is fundamental, isn't it?
Oh, completely.
Because with a standard conventional mortgage, the lender wants to see everything your pay stubs, W-2s for the last 2 years, possibly 3 years of tax returns, proof of employment stability.
A deep dive into your personal spending habits, your credit history is crucial, your personal debts are meticulously calculated.
Right. It's all about your personal ability to repay the loan from your income sources outside of the property.
Precisely. DSCR loans fundamentally diverge from that traditional path. Instead of that extensive and sometimes, frankly, intrusive personal income verification process.
Yeah, it can feel that way.
The qualification process heavily and often almost exclusively relies on one critical financial metric related to the property, the debt service coverage ratio, or DSCR.
Got it. Hence the name.
Exactly. This is why they fall under the category of non-qualified mortgages or non-QM loans.
Non-QM.
They don't adhere to the strict, standardized underwriting rules set by entities like Fannie Mae and Freddie Mac that govern conventional mortgages and require that detailed personal income documentation.
Okay, so if they're not for everyone, who are these loans ideally designed for? Who really benefits the most from this structure based on what we're seeing in the sources?
Well, the sources paint a pretty clear picture of the target audience. It's real estate investors, particularly those who find traditional financing restrictive or challenging for specific reasons.
Like who?
A prime example is the self-employed individual. Many successful business owners strategically utilize tax deductions to lower their taxable income.
Right, makes sense for taxes.
It's smart financial planning for their business and personal taxes, but it can make their reported income on a tax return look much lower than their actual cash flow or overall financial strength.
So the tax return doesn't tell the whole story.
Not at all. Traditional lenders look at those tax returns and see insufficient income for qualification, even if the person has substantial assets or cash flow not reflected on lines 130 of a 1040.
Yeah.
The TikTok examples you included vividly illustrate this clients with significant write-offs, or those who simply prefer not to disclose extensive personal financial details can qualify based purely on the property's numbers.
Ah, so it's a way around showing maybe lower declared income.
Exactly. It's a lifeline for investors whose wealth or income structure just doesn't fit the standard W-2 employee box.
That makes a lot of sense. You could have millions in the bank, be incredibly profitable in your business, but because of how you minimize taxes, conventional lenders say no.
Precisely. Another major group that benefits are experienced investors who are looking to scale their portfolios beyond the limits imposed by conventional lenders.
That 10 property cap again.
Yeah. Traditional mortgages typically cap an individual at financing 10 properties across all lenders. For investors building a large portfolio, this limit is a significant barrier.
Gets a wall.
Right. DSCR lenders often have no limit on the number of properties financed with this product.
No limit, really.
Often, yes. This allows investors to continue acquiring properties, sometimes even multiple properties simultaneously, unlocking significant portfolio growth opportunities that would be impossible with conventional financing alone.
Wow, okay. That's huge for growth.
It's clearly presented as a tool to invest in profitable properties without being constrained by those traditional income hurdles or portfolio size restrictions.
So the name itself, DSCR, comes from a ratio. Let's actually break down that calculation. How is the DSCR determined for a property in the eyes of these lenders?
Yeah, let's get into the math, but it's pretty straightforward once you understand the two main components.
Okay.
The debt service coverage ratio, or DSCR, is calculated by taking the property's net operating income, NOI, and dividing it by its total debt service.
So DSCR equals NOI divided by total debt service. Simple enough formula?
Yep, DSCR equals NOI, total debt service.
All right, let's go deeper into those components. What exactly constitutes net operating income, NOI, in the context of a DSCR loan application for a rental property? It's not always the same as standard accounting NOI, is it?
That's a really good point. In this specific lending context, NOI is primarily derived from the income generated by the investment property. The most significant part of that income is, of course, the rental revenue.
The rent checks.
Exactly. Now, there's a nuance here, depending on the lender, as highlighted in the sources. Some lenders might simplify the calculation numerator for the DSCR ratio by focusing primarily, or even solely, on the gross scheduled rental income.
Just a top-line rent.
Sometimes, yes. Perhaps based on market rent determined by an appraisal, or for short-term rentals, projected income from tools like AirDNA.
Okay.
Other lenders might use a slightly more traditional definition of NOI, which would involve taking the gross rental income and subtracting typical operating expenses other than the mortgage debt itself.
Like taxes, insurance, management fees.
Exactly. Things like property taxes, insurance, property management fees, maintenance reserves, utilities paid by the owner, etc. However, for the direct DSCR calculation comparison to the debt service, which includes taxes and insurance, the sources often lean towards comparing income, like market rent, directly against the full PTA payment.
PTA, let's define that in a second.
Right, but one source specifically defines the NOI component for their DSCR calculation as the lower of the current lease amount or the market rent.
Ah, so they take the more conservative number.
Typically, yes. It's a crucial distinction to confirm with a specific lender, but the core idea is, what income does the property bring in?
Got it. So It's mainly about the rent the property can command, though the exact expenses subtracted for NOI might vary slightly depending on the lender's specific method. And what about the denominator, the total debt service?
Okay, total debt service represents the total cost of the loan payment on the property.
Yeah.
And crucially, this isn't just the principal and interest payment.
Right, it's more than just P&I.
Definitely. It typically includes principal, interest, property taxes, the cost of property insurance, and any applicable homeowners association, HOA, dues, or assessments.
So that's the PITI you mentioned.
Exactly. One of the sources uses that helpful acronym, PITI, principal, interest, taxes, insurance, and assessments, to encompass all these costs that contribute to the total monthly obligation for the property under the new loan.
Okay, PITIA.
Got it. So total debt service is the full monthly PITI amount, often annualized, multiplied by 12, when calculating the annual DSCR, though the ratio is frequently discussed in terms of monthly figures compared directly.
Okay, so you take the property's income, predominantly the rent or projected rent, and divide it by the total estimated monthly cost of owning the property with the new loan, including the P&I, taxes, insurance, and HOA. The result is that ratio.
That's the number.
How do you interpret what that number actually means? What does a 1.2 DSCR tell you versus, say, a 0.9 DSCR?
The interpretation is really key to understanding the lender's perspective on risk.
Right.
If the DSCR is above 1.0, it means the property's income is more than enough to cover the total debt obligation. For example, a DSCR of 1.2 means the property generates 1.2 times the income needed to pay the debt.
So 20% more income than the payment, positive cash flow.
Exactly. It indicates positive cash flow relative to the loan payments with a built-in buffer.
And if it's exactly 1.0?
If the DSCR is exactly 1.0, the property's income precisely covers the total debt payment. There's no buffer. The income exactly meets the obligation. Break even, essentially.
Okay, and below 1.0?
If the DSCR is below 1.0, the property's income is not enough to cover the total debt payment. For instance, a DSCR of 0.8 means the property only generates 80% of the income needed for the debt service.
Uh-oh. Negative cash flow relative to the debt.
Correct. This indicates negative cash flow relative to the debt, meaning the borrower would need to supplement the property's income with personal funds to make the full mortgage payment.
The sources really help make this concrete with real-world examples.
They do, and that helps ground it. One example shows a property with a market rent determined by an appraisal of $2,200 per month.
Okay.
And the estimated subject, PITO, the full monthly loan payment, including everything, is $2,000 per month.
Right.
Dividing $2,200 by $2,000 gives a DSCR of the 1.10.
1.1. So that property's income covers the debt and provides a 10% buffer. Makes sense.
Exactly. Another example uses annual figures. If our property generates $120,000 in net operating income annually, and the total annual debt service is $100,000.
$120K divided by $100K.
The DSCR is 1.2, $100,000, a 20% buffer.
And I found the example showing the impact of increasing income particularly insightful.
Oh yeah, that one really shows the leverage.
If a property is currently bringing in $10,000 a month with a $7,000 total debt service, that's a DSCR of, 1.43, 10,000 to 7,000.
Right, a solid 1.43.
But if you can increase that property's income, say by renovating units or raising rents to $12,000 a month, while the debt service remains at $7,000.
The payment stays the same, but the income goes up.
The DSCR jumps significantly to 1.71, $12,000, $7,000.
Almost 1.7. That's a huge difference in perceived safety for the lender.
Absolutely. These examples clearly demonstrate the direct relationship.
Yeah.
Higher income relative to the debt payment results in a higher DSCR, which signals greater financial health and lower risk for that specific property in the eyes of the lender.
It's all about that cushion.
So why do lenders specializing in DSCR loans put so much weight on this single ratio, especially when they aren't scrutinizing the borrower's personal income as much?
Well, for these lenders, the DSCR is their primary method of assessing the risk inherent in the loan based on the collateral itself, the property's ability to perform.
Focusing on the asset's risk profile.
Precisely. Since they are intentionally moving away from verifying the borrower's personal income streams from jobs or businesses, they need a reliable measure of the property's financial viability. The DSCR provides that critical snapshot.
Like a quick health check for the property's finances.
Exactly. It tells them, purely based on the property's expected income versus its expected debt costs, how likely it is that the payments will be made from the property's own operations. It's a focused risk assessment on the asset, not the person's W-2.
What kind of DSCR threshold do these lenders typically look for to approve a loan? Is there a standard number?
The sources generally indicate that lenders are often seeking a DSCR of 1.2 or higher.
1.2. Okay, that 20% buffer seems common.
Yeah, it provides that 20% cushion between the property's income and the debt payments, giving the lender more comfort. However, and this is where it gets really fascinating, and emphasizes the importance of shopping around. The sources highlight a massive range of requirements. Some lenders require a higher buffer, like Lima One Capital, which requires a DSCR of 1.5 or more.
1.5. Wow, that's a 50% buffer. Pretty conservative.
Very conservative. But then on the other end of the spectrum, you see lenders willing to go much, much lower. Griffin Funding, for instance, offers DSCR loans with ratios as low as 0.75.
Wow, 0.75. That means the property's income doesn't even cover the full debt payment. It's only covering 75% of it.
Correct. Negative cash flow baked in, at least based on that simple ratio.
And Trust Financial Group is mentioned as even offering no ratio loans. How can a lender be comfortable with a DSCR below 1.0 or even no ratio? What does that tell us about their risk tolerance or how these products are structured?
That range is truly incredible, isn't it? From needing a substantial 50% buffer, 1.5 DSCR, to accepting a 25% shortfall, 0.75 DSCR, or even having no strict income-to-debt ratio requirement. No ratio.
Yeah, it's a huge spread.
It tells us that the market for DSCR loans is diverse, with different lenders catering to different risk appetites and potentially structuring their products differently to compensate.
Okay, so there must be trade-offs.
Exactly. While the sources don't explicitly detail the trade-offs for those ultra-low DSCR loans, common sense and general lending principles suggest that lenders taking on properties where the income doesn't cover the debt are likely mitigating that risk in other ways.
Like what? Higher rates, bigger down payments.
Could be several things. Significantly higher interest rates, higher upfront points and fees, larger cash reserve requirements held by the borrower.
The reserves.
Lower loan-to-value ratios, meaning the borrower has more skin in the game, more equity invested. Or perhaps these specific programs are only available for borrowers with exceptionally strong credit or significant assets elsewhere, even if those assets aren't being used for traditional income qualification.
So they might look at the whole picture a bit more in those cases.
Potentially, yeah. It definitely implies a vastly different risk spectrum across these lenders. An investor needs to understand that qualifying with a lower DSCR might come at a much higher cost or with more stringent terms elsewhere in the loan package.
Right. Flexibility comes at a price sometimes.
The flexibility to qualify based on property performance is the benefit, but the terms of that qualification can vary wildly. You got to read the fine print.
That insight into the range and potential trade-offs is really important. Okay, shifting gears slightly. Who specifically qualifies for these loans beyond the general investor profile, and what types of properties are eligible?
Right. We touched on the ideal investor profiles: self-employed individuals, those with complex finances, and investors looking to scale beyond the 10-property conventional limit.
The usual suspects.
Yeah. However, one nuance mentioned in the sources, specifically by EPM, adds a layer. That source states that first-time investors may not qualify for their DSCR program.
Oh, really? Not for first-timers?
And that borrowers are typically required to have at least 12 months of ownership and management experience with income-producing residential or commercial real estate within the last 12 months.
Okay, so experience matters, even if W-2 income doesn't.
It seems so, at least for some lenders. This slightly contrasts with the general narrative that DSCR loans can help new investors enter the market.
That's a crucial distinction. It sounds like it helps investors who are new to this type of financing, but not necessarily brand new to real estate investing itself. Is that fair?
I think that's a very fair assessment. It suggests that while the income hurdle is removed, some lenders substitute it with an experience hurdle, perhaps to ensure the borrower understands the realities of property management and actually generating rental income.
Makes sense. Landlording isn't always easy.
Exactly. So a truly brand new investor might need to find lenders with different criteria, or perhaps start with a conventional loan on their first property if their personal income allows, before leveraging DSCR for subsequent ones.
Good advice. Verify the experience requirement.
It's vital for a new investor to verify the specific experience requirements of any potential DSCR lender. Don't assume.
Now, regarding eligible properties, the list from the sources is quite comprehensive and flexible compared to conventional loans, right?
Oh, yeah, much more flexible generally. It includes standard single-family homes and 2 for 4 unit properties, duplexes, triplexes, quads.
Bread and butter rentals.
Right. It also covers condos. And notably, the sources mention that often non-warrantable condos are eligible.
Non-warrantable condos can be notoriously difficult to finance with conventional loans. That's a significant advantage.
It really is. That opens up a lot of potential inventory in certain markets.
What else?
The list continues with planned urban developments, PUDs, larger multifamily properties, though the maximum number of units might vary by lender.
5+ units.
Often, yes. And even commercial properties are mentioned by one source as potentially eligible.
Okay, so it spans residential and even some commercial.
And of course, these are increasingly popular for a specific type of investment property. Vacation homes and short-term rentals.
Right, the Airbnbs and VRBOs.
Yeah.
That market's huge. How do lenders handle the income verification for properties like those where the income isn't based on a long-term lease? It fluctuates, right?
Yeah, it's a key point, and the sources address it. Lenders understand that short-term rental STR income can fluctuate seasonally and isn't based on a fixed lease. They typically rely on market rent data or specialized third-party reports.
Like AirDNA.
Often from services like AirDNA, exactly. They use those tools to project the potential income for an STR property. These tools analyze booking data, occupancy rates, nightly rates for comparable properties in the area to estimate realistic revenue.
So they're using market comps for potential income.
Right. One source, Griffin Funding, specifically notes that for STRs, they typically look for a DSCR of 1.0 or higher based on that projected income.
1.0 or higher for short-term rentals. So break even or better based on projections.
Seems to be a common threshold for STRs, yeah. So while the verification method differs from a long-term lease, the core principle of income covering debt remains.
Another major advantage mentioned in the sources is the ability to borrow under an LLC or other business entity. That's big for investors.
Yes, this is a huge benefit for portfolio investors and a common practice with DSCR loans. Far more so than with conventional residential mortgages, which are primarily made to individuals.
Why is borrowing in an LLC so important?
Financing under an LLC provides legal and financial separation between your personal assets and liabilities and your investment property's assets and liabilities. It offers a layer of personal asset protection that is highly valued by experienced investors.
Protects your personal stuff if something goes wrong with the property.
That's the idea. Helps keep things clean.
Is there a strict rule about how these properties must be used? Can you live in one unit?
Good question. Absolutely, and this is non-negotiable based on the sources. DSCR loans are strictly for investment properties only.
No owner-occupants.
None. The borrower cannot occupy the property as their primary residence, nor can they intend to occupy it. This rule even applies to multi-unit properties. If you plan to live in one unit of a duplex or triplex you're buying, that property typically would not qualify for a DSCR loan.
Even for a house hack. Interesting.
Generally not for DSCR, no. Borrowers are usually required to sign an affidavit at closing, a legal document confirming their intention to use the property solely as a rental or investment property.
Okay, so strictly for generating income, not for personal use.
Yeah.
Got it. Beyond the DSCR and property type, what about other standard loan requirements like credit score or down payment? Do those still apply?
Yes, absolutely. While personal income isn't the primary focus, other aspects of your financial health are still considered, especially your creditworthiness.
Credit score still matters.
Very much so. Credit score is a key requirement. The typical minimum credit score requirement mentioned in the sources is often around 660, which is, fairly standard, maybe slightly more flexible than top-tier conventional.
Like 60 minimum. Okay.
However, some lenders require higher scores, like 600 or even 700 plus 60, with Lima One Capital specifically requiring a 700 FICO score.
So it varies, but you need decent credit.
Definitely. As with any lending, a higher credit score generally indicates lower risk to the lender and can lead to more favorable terms, such as a lower interest rate.
And the down payment, are we talking 5% down like some first-time buyer loans?
Oh, definitely not. Down payments are required, and they are typically higher than what you might expect for a conventional owner-occupied mortgage.
How much higher?
The standard expectation mentioned in the sources is often in the range of 20% to 25% of the purchase price.
Okay, 25% down. That's standard investor territory.
Pretty much. And for specific property types or borrower experience levels, it might be even higher. For example, one source noted that for short-term rental properties, the minimum down payment might be 25% for experienced STR operators, at least 1 year of experience, and 30% for those with less experience.
So more down if you're newer to STRs. Makes sense.
Yeah, higher perceived risk, higher down payment. So you need to be prepared for a substantial upfront equity investment. No low down options here typically.
What about the size of the loans available? Are there upper limits? How big can these get?
Yes, there are typical ranges, though again, they can vary quite a bit by lender. The sources suggest that loan amounts from $100,000 up to maybe $3 million are common for DSCR loans.
100K to $3 million. That
Yeah.
covers a lot of ground.
It does. However, there are lenders who go higher. Griffin Funding, for instance, mentions loan amounts up to $5 million.
$5 million.
And one source even hinted at the potential for up to $6 million on certain properties, though that's probably less common, maybe for larger multifamily or commercial deals.
Okay. And specific lender caps mentioned.
Yeah. The sources noted Angel Oak up to $1.5 million and Trust Financial Group up to $3 million. So the maximum loan amount will depend on the specific lender's programs and risk appetite, as well as the property value and, of course, the DSCR.
And you mentioned borrowing under an LLC requires documentation. Even if the state doesn't?
It often does, yes.
Yeah.
This was an interesting point in one source. Even if your state's laws don't require a formal operating agreement for your LLC.
Like for a single-member LLC sometimes.
Right. Lenders providing DSCR loans will very likely require you to provide a copy anyway.
Why is that?
The reason, as one source, EPM clearly explained, is that while the LLC is the legal borrower, the lender needs to understand who the human being or beings are behind that entity who is the sponsor or guarantor.
They need to know who they're ultimately dealing with.
Exactly. The operating agreement is crucial documentation to verify ownership percentages and identify the key individuals who have control and legal right to the property through the LLC structure. It ensures transparency regarding the beneficial ownership of the borrowing entity.
Makes sense. They need to know who's responsible.
Oh.
Okay, that covers the requirements and mechanics pretty well.
Hmm.
Let's pivot to the why. Why would an investor choose a DSCR loan over traditional financing, even if they could potentially qualify conventionally? What are the major benefits highlighted in the sources?
Well, the most significant, really game-changing benefit, and the one cited most frequently, is the ability to circumvent traditional personal income verification.
That's a headline, right?
Absolutely. That's the core appeal. As we discussed, you generally don't need to provide W-2s, recent pay stubs, or often even full personal tax returns that show high reported income.
Huge for some people.
It is. For self-employed individuals, those with complex tax situations involving significant write-offs, or those with substantial wealth tied up in assets rather than high salaries, this is, frankly, revolutionary.
How so?
It allows them to qualify based purely on the investment property's income potential and the resulting DSCR, opening doors to financing that conventional banks would keep firmly shut. Think about those TikTok examples again, clients who are successful but don't fit the traditional income mold on paper. DSCR loans are built for them.
So you're not being penalized by the lender for being a smart business owner with tax write-offs.
Exactly, you said it perfectly. It focuses on the asset's performance, which is the true driver of investment return anyway, not how well you minimize your personal tax burden.
What else? Speed.
Yes, another often cited benefit is speed and efficiency. Because the underwriting process doesn't involve digging deep into years of personal financial records and employment history.
Less paperwork.
Way less personal paperwork.
Yeah.
The application and approval process for DSCR loans can often be significantly faster and more streamlined than with conventional mortgages.
And that matters in hot markets.
It can be a crucial advantage in a competitive real estate market where quick closing can help an offer stand out. Speed wins deals sometimes.
And the portfolio growth we touched on earlier, that seems massive.
Yes, for scaling investors, this is arguably the most powerful benefit after the income verification bypass. The conventional limit of 10 financed investment properties simply does not apply with many DSCR lenders.
No 10-property jail.
Exactly. There is often no limit on the number of properties you can finance with DSCR loans. This enables investors to build their portfolios far beyond that traditional cap, acquiring multiple properties financed this way simultaneously or sequentially, facilitating much more aggressive growth and wealth building. Unlimited properties. For a serious investor, that truly is powerful. Game-changing, really.
That capability alone unlocks a lot of potential. Any other specific benefits mentioned in the sources?
Yeah, one source specifically pointed out the potential for unlimited cash out based on property equity with DSCR loans.
Unlimited cash out, how does that work?
It means that once a property has built equity, either through appreciation or paying down the loan, DSCR cash-out refinance loans can allow the investor to pull out funds often based on a percentage of the current market value, the LTV, or loan-to-value ratio for the refinance, for various purposes.
So you can tap into the equity easier.
Potentially, yes. This could be funding renovations on the property itself, providing down payments for additional properties or other investment needs, all while maintaining the financing based on the property's cash flow potential. It keeps the momentum going.
Very useful for portfolio building. And finally, the LLC structure benefit again.
Yes, just to reiterate, the ability to borrow under an LLC, which is standard and often encouraged with DSCR loans, helps investors keep their personal finances and assets clearly separate from their business activities and liabilities.
Legal protection and cleaner books.
Crucial for legal protection and simplified accounting for their real estate investment business. It's just good practice.
Okay, those are some compelling reasons why an investor would choose this route. Bypassing income hurdles, speed, unlimited properties, cash out flexibility, legal separation. Powerful stuff.
Definitely a strong value proposition for the right investor.
But as you said, no loan product is perfect. What are the potential limitations or downsides an investor needs to consider before pursuing a DSCR loan? The flip side.
Right. Always got to look at the flip side. The most commonly cited potential downside is the interest rate.
Higher rates.
Typically, yes. DSCR loans usually come with higher interest rates compared to traditional conventional mortgages offered to borrowers with impeccable W-2 income and low debt ratios.
Why is that?
It reflects the different risk assessment model. The lender is taking on slightly more perceived risk by relying primarily on the property's performance rather than the borrower's proven personal income stream. So they price for that risk.
Okay. Higher rate is the main trade-off. Are there risks associated with the loan structure itself that differ from conventional loans?
Potentially, yeah. It depends on the specific terms negotiated. While many DSCR loans are available with a standard 30-year fixed interest rate, which provides stability.
30-year fixed is good.
It is. But some programs may include interest-only periods or have shorter overall terms like 5, 7, 10, or 15 years, potentially with a balloon payment at the end.
Interest-only or balloons? That sounds riskier.
It can be. With an interest-only period, your monthly payment is lower initially as you're only covering the interest, but you're not paying down principal.
So the loan balance doesn't go down.
Correct. This means your loan balance doesn't decrease, which can be risky if property values decline, potentially leaving you owing more than the property is worth or underwater.
Right. And balloons.
Shorter terms or balloon payments mean you'll face a much larger payment or need to refinance relatively quickly, introducing future interest rate risk or the risk of not qualifying for a future loan when that balloon comes due.
So you need an exit strategy for those.
Absolutely. Got to plan for that refinance or sale.
And are the upfront costs or reserve requirements generally higher too?
Yes. You can generally expect a larger down payment requirement compared to conventional owner-occupied loans, as we discussed. 20-25% is common, sometimes more.
More skin in the game.
Right. Additionally, DSCR lenders will almost always require borrowers to have substantial cash reserves funds held in reserve, usually in a bank account, to cover potential periods of vacancy or unexpected expenses.
How much in reserves usually?
The amount required can vary, but is often several months' worth of mortgage payments, PITIA, sometimes 6 months or even more, especially for short-term rentals where income fluctuates more.
So you need significant cash on hand, not just the down payment.
Definitely. This is a critical buffer for the lender to ensure payments can still be made, even if the property isn't generating full income for a while.
That brings up the inherent vacancy risk, which seems particularly relevant when the loan is based entirely on property cash flow.
Absolutely. It's the Achilles heel, potentially. While the DSCR model focuses on that property cash flow, that cash flow is entirely dependent on the property being rented.
If it's empty, no cash flow.
Exactly.
Yeah.
If the property is vacant, whether for weeks or months, the income drops to zero, but the mortgage payment is still due. The borrower remains legally responsible for making those payments.
Still on the hook personally, even if it's in an LLC.
Often there's still a personal guarantee, or at least the property itself is at risk. If an investor hasn't built up sufficient cash reserves, or if they rely solely on the property's income and don't have other personal funds available, prolonged vacancies can lead to significant financial strain, defaulting on the loan, and potentially foreclosure.
So good management and reserves are key.
It highlights that while income verification is bypassed, effective property management and sound financial planning, like maintaining those reserves, are still crucial investor responsibilities. You can't just set it and forget it.
And finally, as we've hinted at with the range of DSCR requirements, the terms can vary wildly between lenders. It's not standardized.
They really do. This isn't a cookie-cutter product like a standard Fannie Mae 30-year fixed conventional mortgage, where terms are pretty similar across lenders.
When like the Wild West.
Maybe not quite the Wild West, but definitely more variation. Each lender has its own specific underwriting criteria for DSCR minimums, from that 0.75 all the way up to 1.5 plus. Loan-to-value ratios, how much they'll lend against the property's value, eligible property types, minimum credit scores, and borrower experience requirements.
In the loan structures, too.
Yes. The terms offered, fixed versus ARM, 30-year versus shorter term, interest-only options, also vary significantly. This makes shopping around and comparing offers from multiple lenders absolutely essential to find the best fit and most favorable terms for your specific investment property and financial situation.
Got to compare those term sheets carefully.
Very carefully. Don't just jump at the first offer.
This market analysis from the American Association of Private Lenders, AAPL, that you've included, is particularly fascinating. It shows that DSCR loans aren't just a niche product. They're a rapidly growing segment of the market.
They really are. The data from Lightning Docs, which is a platform widely used by private lenders, provides a clear picture of this surge. It's quite dramatic, actually.
Like how dramatic?
DSCR loan volume saw an incredible year-over-year increase of 52% across their users in 2024. 52%.
Wow. 52% growth in 1 year. That's huge.
It is, and the growth didn't just maintain momentum, it accelerated dramatically into the start of the new year. January 2025 showed an astounding 123% year-over-year increase in DSCR loan volume compared to January 2024.
123%. Doubled and then some, year over year for January.
Exactly. That is truly massive growth, indicating strong adoption and origination activity. It's becoming much more mainstream in the investor lending world.
What does the AAPL report credit for driving that kind of momentum in the market? Why the big surge?
The report points to strong conditions in the secondary market, essentially, the market where these loans are packaged and sold to investors, and the revival of loan securitization.
Securitization. Okay, explain that simply.
Basically, securitization means lenders can bundle a whole bunch of these DSCR loans together and sell them off as mortgage-backed securities to institutional investors, like pension funds or insurance companies.
Okay, they package and sell the loans. Why does that break growth?
This process is critical because it frees up the original lender's capital. They get their money back quickly, allowing them to turn around and make more new loans.
Recycles their capital faster.
Precisely. When the secondary market is strong and investors are eager to buy these securitized products, it increases liquidity for DSCR loans, making lenders more willing and able to originate them, which directly drives that volume growth we saw.
So a healthy secondary market is key fuel for the DSCR engine.
Absolutely essential.
And what have interest rates been doing in this specific market?
Well, the trend report is interesting. Interest rates for DSCR loans generally decreased throughout most of 2024, which likely contributed to the growing volume. Lower rates make deals work better.
Data more attractive.
Yeah. However, they saw an increase in January 2025, marking the third straight month of slight increases. The average national rate reported for January 2025 was 7.69%.
7.69% average. Still higher than conventional, but maybe came down a bit during 2024 before ticking up.
That seems to be the trend, yeah.
What's particularly insightful from the AAPL data is the trend in spreads. Can you explain what the spread is in this context and why its tightening is significant?
Certainly. The spread in this case refers to the difference between the average interest rate for DSCR loans and benchmark interest rates, like the yield on the 10-year U.S. Treasury note.
Okay, the gap between DSCR rates and a baseline rate like Treasuries.
Exactly. The Treasury yield is often seen as a baseline for long-term borrowing costs, kind of a risk-free rate proxy. When the spread is wide, it means DSCR rates are significantly higher than the benchmark, reflecting a higher perceived risk or lower demand from those secondary market investors buying the loans.
So widespread means investors are nervous about DSCR loans.
Or demanding a higher return for the risk, yes. The report notes that the spread tightened dramatically throughout 2024 and into early 2025.
Tightened, meaning the gap got smaller.
Exactly. For context, the spread started 2024 at 424 basis points. That's 4.24 percentage points above the 10-year Treasury.
Wow, over 4% higher.
But it narrowed significantly to 306 basis points, or 3.06 percentage points, by January 2025.
So the gap between DSCR rates and the benchmark narrowed by over a full percentage point. What does that signal? Why did it tighten?
That tightening spread is highly significant. It strongly suggests that the secondary market investors who are buying these securitized DSCR loans are becoming increasingly comfortable with the product and the risks associated with it.
They see it as less risky than before.
Or at least they understand the risks better and are more willing to accept a smaller premium, a smaller extra return, above the benchmark rate to hold these assets. This increased comfort increases demand for the loans in the secondary market,
Which feeds back to the lenders.
which in turn provides lenders with more capital and confidence to originate more DSCR loans, directly driving the volume growth we discussed. It signals a growing maturity and acceptance of the DSCR product within the broader financial markets.
That's a really powerful indicator of market health and acceptance for this product type. What about average loan amounts in this growing market? Did they change much?
The report also tracks average DSCR loan amounts. These amounts actually increased throughout most of 2024.
Anchor loans on average.
Yeah, going from around $270,300 in January 2024 to hitting a peak of $312,465 in December 2024. Okay. However, aligning with that slight uptick in rates maybe, there was a dip in January 2025, bringing the average back down slightly to $281,048.
Interesting. So average transaction sizes grew through the years, but started the new year on a slightly lower note. Maybe higher rates choked off some larger deals.
Could be, or just typical month-to-month fluctuation.
Yeah.
But the overall trend in 2024 was towards larger average loans.
Were there any other notable market trends mentioned, like transaction costs or geographic differences? What about the fees?
Yes, the report mentions that transaction fees, like points, have remained relatively consistent. Lenders are typically charging slightly over 2 points, that's 2% of the loan amount on DSCR loans, which is apparently similar to what they charge on short-term bridge loans.
2 points, okay. Anything else?
Yep. On top of those points, there are additional fixed fees that investors should definitely factor into their costs. Things like document fees, which average between $900 and $1,300, processing fees around $1,000 to $1,300, and underwriting fees between $1,300 and $1,500.
Oof. So maybe $3,000 to $4,000 plus in fixed fees on top of the points. Adds up.
It certainly does. You need to account for all those closing costs.
And geography still plays a significant role. Location, location, location.
Absolutely. Location continues to impact both the interest rates offered and the average loan amounts significantly.
How so?
The AAPL data shows, for example, that states like Texas consistently had lower average rates compared to markets like California.
Lower rates in Texas.
Even though the average loan balances in California transactions were often much larger due to higher property values there.
Right. So rate isn't just about property value.
No, seems more tied to regional market conditions or lender competition. Looking at where the larger loans are happening, it's likely unsurprising that states with high property values, such as California, New York, Massachusetts, Nevada, and Utah, had average DSCR loan balances exceeding $1 million in Q4 2024.
$1 million DSCR loans in those states. Wow. Yeah, big tickets. In terms of where the volume is happening, the number of loans, California, Florida, and Texas remain the consistent leaders for DSCR loan activity. They dominate.
The big three investor states.
Pretty much. Though interestingly, states like Ohio, Texas again, and Missouri showed particularly strong origination volumes starting early in 2025, indicating maybe some dynamic shifts in regional activity or new hotspots emerging.
Okay, so keep an eye on those states too. So the market is vibrant, showing strong growth fueled by secondary market demand, with dynamic trends in rates and average amounts, and location remains a critical factor.
That sums it up well. It's an active and evolving space.
If someone is evaluating a property and thinks a DSCR loan might be the right fit, what does the general process look like? And maybe more importantly, how can they improve their chances of getting approved or securing better terms?
Okay, good practical questions. The process typically starts with the investor themselves doing their own homework first.
Due diligence. Exactly. First, you need to evaluate the potential property's cash flow realistically to estimate its net operating income, NOI, using market rent, projected expenses, etc.
Estimate the NOI. Got it.
Then, using that estimated NOI and an estimate of the potential loan terms you might get, maybe based on preliminary quotes or online calculators for amount and rate, you calculate the prospective DSCR for that property under the new loan.
So you figure out what the likely DSCR will be first before even applying formally.
Ideally, yes.
Yeah.
You want to know if you're in the ballpark. And if that calculated DSCR is below the minimum threshold of the lenders you're targeting, say below 1.2 for many lenders, or below 1.5 if you're looking at someone like Lima 1,
Right.
then you know you either need to improve the property's projected DSCR somehow, Or you need to find a lender with a lower minimum requirement, perhaps one of those offering 0.75 or no ratio loans, but understanding the potential trade-offs we talked about.
Okay. So if your initial calculation shows the DSCR is too low for the lenders you prefer, how can you actually improve that all-important ratio? How do you boost the DSCR?
Well, the strategies for improvement, as highlighted in the sources, directly relate back to that DSCR formula. NOI divided by total debt service.
Increase the top number or decrease the bottom number?
Basically, yeah. You either need to increase the numerator, net operating income, or effectively decrease the denominator, total debt service. Although decreasing the debt service is harder to control directly via borrower action on a new loan's terms, other than shopping for a better rate.
Okay, let's focus on increasing NOI first. How do you do that?
To boost NOI, you focus on increasing the property's income and/or reducing its operating expenses. Pretty straightforward business principles.
Increase revenue, decrease costs?
Exactly. To increase rental income, you can explore raising rents, assuming current rents are below market value. You can work on reducing vacancy periods through better marketing, tenant screening, or management.
Keep it full.
Or you could add income-generating features to the property, like maybe an accessory dwelling unit, ADU, where zoning allows adding corn-up laundry facilities, charging for parking, or offering other desirable amenities that command higher rent.
Value-add strategies.
Right. The case study of John, mentioned in one source, illustrates this perfectly. By renovating units and filling vacancies in his existing property, he was able to significantly improve his property's DSCR from a borderline 1.0 to a much stronger ratio.
Making it much more financeable.
Exactly. Making it more attractive for future cash-out refinancing or portfolio leverage. It shows that improvements directly impact the numbers.
What about reducing expenses? How can you cut costs effectively?
Reducing operating expenses involves efficient property management. This could mean negotiating better rates with contractors or vendors for maintenance and repairs, getting multiple bids.
Shop around for repairs.
Implementing energy-saving measures to reduce utility costs, especially if the owner pays utilities, things like LED lighting, better insulation, efficient appliances. Performing preventative maintenance to avoid costly emergency repairs down the line.
An ounce of prevention.
Is worth a pound of cure, exactly. Or simply managing the property more efficiently yourself if you're self-managing, being mindful of every expense. Every dollar saved on legitimate operating expenses other than the debt itself increases the net operating income numerator and thus improves the DSCR.
So tighten up operations. Makes sense. Are there any other ways to impact the ratio or improve chances beyond NOI?
Well, while you can't typically dictate the interest rate or loan amount offered on a new loan application, which determine the total debt service denominator, actively shopping around and finding a lender offering a slightly lower interest rate or more favorable terms will result in a lower monthly payment.
Lowering the denominator.
Right. Thus, reducing the total debt service and improving the DSCR for that specific property loan. So comparison shopping is key. Beyond the ratio itself, ensuring you have strong cash reserves.
So there's reserves again.
Demonstrating a solid track record as an investor, if that's required by the lender, and maintaining a good personal credit score, even if your income isn't the focus.
Credit still counts.
All contribute to a stronger overall loan application in the eyes of the lender. These factors might lead to better terms, even if the DSCR just barely meets the minimum requirement. A strong borrower profile helps.
So a higher DSCR is always better, generally speaking.
Generally, yes, from the lender's perspective.
Mm-hmm.
A higher DSCR indicates lower risk because the property's income provides a larger buffer over the debt payment.
Safer loan for them.
Exactly. This not only increases your likelihood of loan approval, but it can also potentially lead to more favorable loan terms, such as a lower interest rate, maybe reduced fees, or even a higher maximum loan-to-value LTV ratio, meaning you might need a smaller down payment or could cash out more equity on a refinance.
So hitting that 1.2 or 1.5 makes a difference beyond just getting approved.
It definitely can, yes. A stronger ratio gives you more negotiating power, potentially.
We've mentioned various lenders throughout, and it's clear their offerings are quite diverse. It's definitely not a one-size-fits-all market.
Absolutely not. And the specific examples from the sources really underscore this point. It's worth quickly recapping some of that range.
Yeah, let's hit some highlights.
For instance, we noted New Silver as an example of a lender with no minimum DSCR requirement, really catering to properties or situations that might not qualify elsewhere based on cash flow alone.
The ultimate flexibility maybe with other trade-offs.
Right. Kiavi was mentioned with rates starting at the time of the source at 7.25% and offering LTVs up to 80% on 30-year fixed or interest-only terms. Pretty standard investor terms there.
Okay.
Griffin Funding stands out for offering DSCRs as low as 0.75, that negative cash flow scenario, and having high maximum loan amounts up to $5 million, though requiring significant down payments starting at 20%, and even more for less experienced STR investors.
High leverage potential, but high down payment too.
Seems like it. Angel Oak offers a substantial $1.5 million maximum loan amount and unique terms like a 40-year fixed option
40 years.
and interest-only periods with no limit on the number of finance properties. That 40-year term is interesting for lowering payments.
Yeah, spreads it out.
Trust Financial Group offers those no-ratio options and a wide range of loan amounts from $100K up to $3 million, another flexible player.
Okay.
And then Lima One Capital represents the higher end of the qualification spectrum, requiring that minimum 1.5 DSCR and a 700 FICO score, but offering various terms including 5, 10, or 30-year fixed rates, ARMs, IOs, and balloon options, probably targeting more experienced, well-qualified borrowers.
So from no ratio to 1.5, from $100K to $5 plus, 30-year fixed to balloons, it's all out there.
It really is. That diversity really drives home the point that doing your homework and comparing lenders is absolutely essential.
You really need to find the lender whose specific DSCR requirements, eligible property types, loan amounts, credit score minimums, and loan terms align precisely with your investment goals and the characteristics of the property you're targeting.
Precisely. It's a market with many options, but you have to navigate it carefully to find the right fit. Don't assume they're all the same.
So let's bring this deep dive to a close. We've covered a lot of ground on DSCR loans. Feels like we really unpacked it.
We certainly have. We've defined what DSCR loans are, emphasizing their core difference from traditional income-based loans by focusing squarely on property cash flow.
Right. The property pays the bills.
We've identified who benefits most from this type of financing, primarily real estate investors navigating complex personal finances, those with significant tax write-offs, or those looking to scale their portfolios beyond conventional limits.
The self-employed, the scalers.
We demystified the all-important DSCR calculation itself, breaking down net operating income and total debt service, PITIA, and illustrating how different ratios, above 1, at 1, below 1, are interpreted by lenders.
Got the math down.
We also detailed the specific requirements for these loans, including the typical minimum credit score and down payment expectations, the wide range of eligible property types from single-family homes and multi-units to non-warrantable condos and short-term rentals.
Lots of property types work.
The significant advantage of borrowing under an LLC for protection and structure, and the strict rule that these loans are exclusively for investment properties, never for a primary residence.
Investment only. Big rule.
And we thoroughly weighed the advantages, bypassing personal income verification, potentially faster closing times, the powerful potential for unlimited financed investment properties, the flexibility of accessing cash-out equity, and the benefits of separating personal and business finances.
Lots of pluses.
Against the important limitations and considerations, such as potentially higher interest rates, structural risks associated with interest-only or balloon payments, typically higher upfront costs, including significant cash reserve requirements, and the inherent vacancy risk that must be managed proactively by the investor.
Got to know the downsides too.
Always. Finally, we analyzed the current market landscape, drawing heavily on that AAPL data, which clearly shows a significant surge in DSCR loan activity, driven by favorable secondary market conditions and securitization.
The market's hot for these.
We noted the recent trends in interest rates and average loan amounts, explored the significance of the tightening spread as an indicator of market confidence, and discussed how location and transaction costs continue to factor into the equation.
Geography matters. Fees add up.
And we also provided practical steps for navigating the application process and actionable strategies investors can use to improve a property's DSCR, primarily by increasing income or reducing expenses, and understanding the importance of a strong ratio for loan approval and terms.
How to make the numbers work better.
It's clear that DSCR loans are not just an alternative financing option. They represent a fundamental shift in how certain types of real estate investment are financed, empowering a different profile of borrower, and highlighting the intrinsic value of the income-generating asset itself.
Yeah, it feels like a major tool.
They are a powerful and increasingly popular tool in the modern real estate investor's toolkit, for sure.
And that focus on the asset's performance, rather than the borrower's personal W-2 income, leads us to our final provocative thought for this deep dive.
Okay, let's hear it.
DSCR loans fundamentally shift the lending focus from you, the borrower's personal financial history, and income, to it, the property's intrinsic performance, and its ability to generate income sufficient to cover its debt.
From the person to the property.
Exactly.
Yeah.
How does this change the traditional barriers to entry in real estate investment for entrepreneurs and portfolio builders? And what does this growing emphasis on asset performance mean for the future of building wealth through rental properties?
Does it democratize access?
Or does it simply create a new set of hoops to jump through, centered on property numbers rather than personal ones? Something for you to think about.
It certainly is a shift that empowers investors whose financial lives don't fit the conventional mold and puts a spotlight firmly on the income-generating power of the property itself. It's a fascinating development.
Absolutely fascinating. Well, thank you for joining us for this deep dive into the world of DSCR loans.
My pleasure. Lots to unpack there.
We hope this comprehensive look has given you the knowledge and insight you need to understand this important financing option.
Consider how this type of financing might fit into your own investment strategy, or maybe just broaden your understanding of the evolving world of real estate finance.
Until next time.